You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. And today, that theme of making things simple is going to be a challenge for me. I'm going to try to keep up. And I have such a treat on deck. This will be one of the top rated episodes ever on the Cash Flow Academy because of my guest. I have Dr. Campbell Harvey with me from Duke University, and his curriculum vitae is 10 miles long. So I'm going to put it in the show notes, but suffice to say, he is a major player in economics. And he's one of those few guys that moves once in a while from economics and actually going to predict something. And, many of you might be familiar with with an inverted yield curve. He was the first guy that really started to look at this, say, hey, there's some predictive qualities to this. This is back in probably 1980s, I'd imagine. And he's a special guy. So he's got a new book out. It's called DeFi and the Future of Finance. You're gonna have to try as hard as you can. It's available on Kindle. To keep this thing in stock, it's flying off the shelves. But I welcome and thank Dr. Campbell Harvey, Cam. If I can am I allowed?
Yes, you can call me Cam, Andy. Thank you for having me on the show.
Oh, thank you so much. So I got to say two things. I have two loves in my life, and I'm not good at either of them. The first one is I was a really bad basketball player back in college. And I played at the University of Utah. And my wife, when I turned 50, decided she wanted to kill me. And she says, how can I do this without getting caught? She says, I'll buy my husband a week at Coach K's K Academy and make him run up and down Cameron Indoor Stadium for a week. And by doing that, I'm pretty sure he will die. And so it was a highlight a couple of years ago before COVID. And when you got a guy like Coach K in here, who's the best at what he does, it tends to bring out the effort. You do things, you dive on the floor. Well, today I have the equivalent in economics. I have the Coach K of economics, and I'm a little nervous that I'm going to have to be diving on the floor today to keep up. So with that, we'll get started. But again, thank you so much. Wow. And you can tell I don't get intimidated very often. I've met like Magic John stuff, but Coach K and Coach Cam here have me trembling in my shoes.
Yeah, nothing like raising expectations too high.
Oh, okay.
So we're sure to disappoint.
Well, when the one thing on campus that really struck me is the palpable is probably not the right word, but it's the best one I can find. There is a standard of excellence throughout that university. Everyone you talk to, everywhere you go, it's amazing. I mean, it's expected to be the best. So we have the best today. So thank you for that. Three things I'd like to touch on if we can. First, I mentioned that inverted yield curve. Can you tell me I don't want to spend too much time on it because I really want to talk about the book. Could you, but I can't resist the chance to say, what made you think of that? What was it about the yield curve where all of a sudden you had an epiphany and said, hey, this has got some predictive power to it?
It's an interesting story. So I'm doing my master's and I took a summer job, after my first year, and it was a dream job. I was put in corporate development at the time, the largest copper mining firm in the world in Toronto. And the price of copper moves with the business cycle. So they needed to know to some degree what was going to happen to GDP growth. And I was put in charge of developing a model as a student. And obviously with copper that you really need to know because copper moves very closely with economic activity, and the decision to open new capacity, to close down a mine, all of this was part of it. So I started off with an intuition because I was studying finance, and finance is all about the future, right? So accounting is understanding the past, which is also important. So I was thinking, well, these financial assets actually contain information about the future. So the price of a stock today is your best guess of what's going to happen to future profits and stuff like that. So I did some research and found that the stock market was not a very good indicator of future economic growth. And the reason's kind of simple. There's no fixed maturity. Dividends are discretionary, and risk can go up and down. So what I did was say, well, what about undoing some of that uncertainty? So instead of looking at a stock with a potentially infinite horizon, let's look at a 5-year bond or a 10-year bond. It would take the risk aspect out because it's going to be a treasury bond. And the dividend that is very variable, well, we take that out because the coupon is fixed. So you put that all together, and of course, an interest rate contains information about expected inflation and expected real interest rates, and also a risk premium, which for government bonds is small. But that real rate is very linked to economic activity. So I looked at this and I put something together that looked very interesting and was just about to present it when the company eliminated my division. So completely gone, laid off.
Wow.
So then I had 4 extra weeks to work on this stuff just on my own. And I went back for my second year and I presented the paper to a faculty member that I was doing some work for. And he was surprised that this looked really interesting, because I found that the inverted yield curve was a very good predictor of future recessions. So he said, this is really interesting. In the school, what they did was there were some required courses I had to take. They collapsed them into a single course to write a single paper.
Wow.
And that's what I worked on. And then I wrote the paper. And then they said, well, you need to do a PhD. And I had no idea. What's that? And then I applied to various schools. And I didn't know at the time that my application was pretty well the ideal application, because what I did is I did the usual stuff you have to do for an application. But I said, well, this is what I'm working on. And here is my paper. So they get the application with the paper. They said, well, this person's thinking of research already. Yes. Usually you do a couple of years of courses, but no, I'm thinking of the research, and I get accepted at various places, decide to go to the University of Chicago. Yes. So I continue my research. It actually, given I'm working on it immediately, it didn't take me that long to actually get through Chicago, but I presented, and it's basically, my committee pretty skeptical
really
of a measure. Yeah, of course. That you have 4 recessions, and I predict 4 out of 4. That's not a big sample, but they were convinced by the economic theory. Actually, 3 people on my committee would go on to win Nobel Prizes. So it was a tough committee, you can imagine. But what happens after you publish a finding like this? This is how it goes. And this is not just for economics and finance, but just in general. In the good scenario, the effect that you've uncovered gets weaker. And in the bad scenario, the effect completely goes away. It was truly a lucky finding. So it turns out that didn't happen with my metric, that the next 4 recessions were predicted in advance with this indicator. And so far, there hasn't been a false signal. So it's 8 out of 8. And I should put an asterisk over the last one, because in June of 2019, I called for a recession in 2020. Obviously, the yield curve doesn't forecast COVID.
Correct.
But there's reasons to believe that we would have gone into recession anyways, but, with no COVID. But yeah, so that's my story. It's remarkable that I still get questions about my dissertation so many years later, but maybe the next time it won't work and people will forget it.
Well, I don't know. When it happened in 2019, it's funny, guys like me, our phone blow up because we'll just text each other. Oh, the yield curve just inverted, because it has had it's had an impeccable track record. So I think
it's interesting that a bigger success, in my opinion, was the global financial crisis, where it inverted well before that. And at the time, it was just ignored. But after the crisis, people started to look, oh, well, how could we ignore that inverted yield curve?
At the risk of asking the same question on a new episode of my podcast, I hope the listeners don't mind, because I think it's great to ask the same question to different experts. An inverted yield curve to me is probably not in the same species, but maybe the same phylum or genus of backwardation and contango. Is that fair to say? Maybe they're cousins, they're not really close. But you look at commodities today, and they're like the yield curve, it's about the future. And people are trying to determine, in the yield curve, we're saying, what should I pay for money now and what should I pay for money later? And in commodities, we're trying to say, what should I pay for corn now and what should I pay for corn or copper, as you mentioned, later? And what I think is interesting is you have, I'll just share this with you. You have the Federal Reserve balance sheet that has just grown. We're at about 8 trillion now, and we've got a lot of deposits. And you look at that and you would say that's deflationary, or that's inflationary. I mean, that's a lot of money creation in a, just crazy. You mentioned, the bubble of the subprime meltdown and how the Fed changed their policy. Late 2019, before the coronavirus hit, they kind of said, we're not going to unwind this. Even before coronavirus, they started heating up again, and then of course the floodgates open. But with that said, a lot of commodities are in backwardation. They're saying, the inflation's transitory. And I thought you made a great comment saying that, stocks the price of a stock is supposed to be an idea of what, the earnings should be in the future. It's a forward-looking statement, as they often say. So what's your take quickly on inflation before we get into DeFi, which will be the heart of our conversation? What's your thoughts on inflation, Fed policy, unprecedented fiscal on the fiscal side? I've never seen anything like it. And it seems like we're going beyond COVID with lots of stimulus. So what's your thoughts on fiscal policy, monetary policy, inflation?
So that's a lot to discuss. So let me be very specific. So maybe you could link to my latest research paper on the best strategies for inflationary times, where we look at almost 100 years of data in 3 different countries, isolate the inflationary episodes, and where you have inflation surges, and we're very careful the way we do it. For example, if inflation is negative and you surge to, let's say, 2%, that's not an inflation surge. That is like getting back to normal.
That's their
So
goal.
a lot of research, very naive here. So if it goes from 2% to 6%, that's a surge.
Yeah.
So, and also the surge is going to last more than a month. So we actually do that and look at the performance of different asset classes, including the commodities that you mentioned. Commodities, you need to be careful because there's other stuff going on. Just like the stock market, I said, supply chain and various things that could cause noise in those commodities. But you're right that there's information in the term structure of commodity prices that I've used in my paper with Claude Herb on strategic and tactical allocation to commodity futures. Maybe you could link to that one also. But on the inflation, this is really important to realize that our policymakers want to convince people that this is transitory. Yeah. And there's a very particular reason for that. And it's called self-fulfilling prophecy or self-fulfilling expectations. That if people believe that inflation is going to be higher, that you're going to ask for a higher wage increase. You're going to raise your product prices. And that essentially feeds into a higher inflation. So they will do their best. They'll go through the story. Oh, well, it's a base effect, or it's, supply chain is temporary, or this is just transitory. And I think that it's highly misleading. And all you need to do is to look at the components of inflation. And there's a couple of components that get a lot of press, like used cars. But used cars is a trivial portion of the CPI. Why not look at the parts of the CPI that are important and they don't get the same sort of press? For example,
what about the things that are not in the CPI, like food and energy as well, right?
yeah.
That
So
matters.
again, what is inflation?
Yeah.
Right. So, so you can have headline, you can have the core, you got a PCE, or that's the one the Fed uses, the personal consumption expenditure deflator. There's GDP deflator. Look, inflation is different for every single person. So everybody's got their own basket. But let's just focus on the CPI. And 1/3 of the CPI is in the shelter category. So that's basically rent and rent that they infer from housing prices. And that is running well below the headline number of 5.4%. So I believe that shelter is about 2.8% year over year. Now, how does that square with what we know just by simple observation in terms of housing? So look at the Case-Shiller 20 city index is up 18% year over year. So you know what's going to happen here, that it just takes a while for that to be incorporated in the CPI. And that means that this is not a temporary issue. It's more on the permanent. And by permanent, I mean, let's say 2 or 3 years.
Yeah.
And it's really obvious also, people talk about, supply chain disruptions, that this is not a 1 or 2 month problem. This is a much more serious problem. And it's not going to go away that quickly. So for me, I believe that this is more of a permanent issue, but I understand why people want to talk it down. But to be clear, I have no other agenda, right? So I have no policy appointment. I have no trade on. This is the way I see the data and my best judgment, and that judgment is that it's a serious mistake to brush this off as transitory. You mentioned the balance sheet, which is staggering.
It takes your breath away, really.
Yeah, we need to be careful that just because the balance sheet is high doesn't necessarily guarantee inflation. And effectively, what's happening is that there's a huge amount of excess reserves where the banks are putting much more than the required. And they get actually paid for that.
0.15.
Yeah, not much, but in today's environment, what happens potentially on the downside is that if those excess reserves are repatriated, that could be inflationary. And ideally, what you do is you reduce those excess reserves in step with nominal GDP growth. So GDP growth is really important. If you think about, you said extraordinary fiscal and the debt situation that the government's in, think about there's 3 different ways out of that problem. And 2 of them are really unattractive.
Can I try to guess them?
Sure.
Let me take my test. I would say number 1, you say you reduce spending, you increase taxes, or you grow the GDP. Is that close?
Yeah, it's really close. So number 1, I would say
I'll never be able to get into Duke Business School, so I'm not very smart.
You really got 2 out of 3, so that's a passing grade. Okay, so that's way better. So 1 is to inflate. So you just print money.
Yeah.
So you could do that, and that's like a tax on
that's
especially
MMT, right?
Yeah, that is not just MMT, but it's related to MMT. And then the second, you hit directly that we could tax, but tax is bad. Like nobody wants to tax. It's toxic politically. And then third, you can grow your way out of this. And the problem is that we're stuck in this very low growth mode. So we're stuck at 2%. Europe is 1%, and Japan is 0%. And this is actually a good segue to my book, because Japan, that is exactly what I address.
And Japan at 0, this is interesting because Japan at 0, they got a debt to GDP of probably 250, and they kind of led this idea of debt, right? I mean, they've had a debt to GDP that's been And the MMT guys say, well, look at Japan. It hasn't hurt them. They've had a debt to GDP of 250 for how long, right? So it's interesting. Just MMT, real or baloney?
Yeah. So modern monetary theory,
Yeah.
number one, isn't modern, and number two, is not a theory. So the monetary, yeah. So it is, to me, naive.
Okay.
So, and we need to be careful here. So Japan is being held as an example. There's two factors you need to take into account in Japan. Number one, the debt is owned internally. So the JGB market is gone. So the bonds are just bought by the BOJ. And most of the other bonds just held by the public. That's much different than the US, where much of our debt is held externally. And then number two,
I got it right down. That's great.
The lack of growth, you could say, is a result of this. So, so what you get is a system where you've got very lethargic growth, if any. And the key, for me at least, is we need to move to a different model where we've got more robust growth opportunities. And the current centralized financial system is not serving us well right now in that respect. And that's basically the first page of my book.
As we leave this conversation of inflation and into the DeFi conversation, I would just say that if you hit 5% inflation and it finally sinks into the CPI or even any of the other indexes, the Fed's now forced to change policy. And I don't want people to be lost on what you said about the rhetoric, because there was a paper, or a speech rather, given by Ben Bernanke way back in 2002 that kind of revealed his thinking. He said, like gold, the US dollar is only valuable as its limited supply because we can print it, or by credibly threatening to do so. And I thought that was very revealing when he said a threat or just the declaration of what they might do is a hope in that they can change policy. That bothered me when he said, oh, we could just threaten to do this. So I thought your point to the rhetoric of it was on spot. But if we have 5% inflation, I feel like the market's so detached from corporate fundamentals right now that if the Fed has to step in and put the brakes on with monetary policy, it crushes the stock market because it's so far detached already from corporate fundamentals. Last word on that, and then let's talk about DeFi.
So my examination of the performance of equities in inflation surges, the conclusion is very straightforward. And that is that unexpected inflation in terms of a surge is bad for equities. It basically, you could maybe find a few sectors that on average do better than other sectors, like maybe the energy sector in stocks, but even that is negative. So it's almost like nowhere to hide in just plain kind of buy and hold stock strategies. So, and there's plenty of economic reasons as to why this happens. And most firms don't have a lot of market power. So that means when the price of their inputs go up, they can't pass it all on to consumers. And if you can't pass it on, then your profits are going to go down. And it's very bad for equities. It's obviously bad for bonds, right? Because as expected inflation goes up, rates go up, prices go down.
Yeah, it's bad. DeFi, to the meat of this, it took us our whole time to get there, but I'm grateful for your time because this is huge. Crypto, I've been skeptical of crypto because of its volatility. I know it's a thing. I've traded it. I don't trade it because it's just not something you can trade. I mean, even technical analysts can't trade it well, I don't think. The few options that are there to protect you are very illiquid at this point. They're terrible spreads. It's not a place I like to play. A lot of my colleagues, Robert Kiyosaki loves Bitcoin. One of the things that I struggle with Bitcoin isn't that I think blockchain is it. The blockchain is a new, it's going to change the world. But I remember the old word processor, word perfect, was kind of the first word process. We went from typewriters to word perfect. And the obsolescence risk of being the first technology in a new era is huge. And I see DeFi as the real thing. I see Bitcoin as kind of maybe remember when we started using Bitcoins and that kind of changed the world, even though we don't use it anymore? I almost feel that'd be my prediction on like word perfect. Remember when word processing changed? We used to word perfect. We don't use it anymore, but that was the first one. That's kind of my fear or feeling or skepticism of Bitcoin. And then the second one is, I don't think people realize that blockchain technology, I think it's going to change the way we vote. In fact, we're probably a little late on that. That would have been really interesting to just declare a winner cleanly with blockchain. I think it's going to change the way we trade stocks. I do not see a need for a bank anymore in this world. And, it's a lot like education. Education is going to get cheaper and cheaper and cheaper as technology gets better, right? I mean, education, a guy can learn almost anything out on Google. There's also the misinformation age, though. You got to be careful with it. But I got to tell you, with blockchain, I don't see a future for banks. I don't see a future for the stock market's going to change, brokerages, because even loans, we have crowdfunding now. You could set up blockchain where we could loan each other money and completely eliminate the financial system. And this is real to me. And so this is why I think this will be one of the top episodes on our podcast, because I've just been talking about this from a guy who had a C- average trying to stay eligible to play basketball. Now we have someone who's actually studied this, written a book on it, who has more credibility than anyone I've ever talked to on the podcast. Can you tell us what DeFi is, why you wrote the book, and let's look in the crystal ball. Accounting is about the past, finance is about the future.
So there's a lot to unpack here. No, I get it. So my book is not about trading cryptos, but we do talk about exchange.
Mm-hmm.
And I will say that the leading exchanges, the spreads that you pay are less than what you would pay in the stock market. Let's say if you're trading Apple, which is a highly liquid stock. So Bitcoin was the first technology, and it is, in my opinion, something that will stick around. But the original vision of Bitcoin was a transactional mechanism, and that really hasn't happened. It can only process.
Can I interrupt you there? See, that's another thing that's bothered me about it is the dollar is a transactional thing. I'm not going to keep $10 million in my checking account. I'm going to keep enough to transact to buy a pizza. And cryptocurrency means movement. It means that you're using it to spend. And I think crypto's become categorized as an investment, almost like a commodity that's not really a commodity, rather than a currency. So I just want to
exactly right. So the original vision was a transactional mechanism, but you can't do much at 7 transactions per second, and it's actually costly to do. So it is a transactional mechanism for large sums. So during my teaching, there was a transaction on the Bitcoin blockchain, $5.4 billion was moved pretty well within 10 minutes. And the fee was $19 to do that. So at a very high level, it's great for that, but you're correct that it's more of a situation where it's a store of value. It's something that you speculate on.
Yeah, it's speculative.
And I guess, that's fine. And it's very limited. So Bitcoin's technology, essentially, you can send money from one person to another, and that's it. So with DeFi that operates in a different blockchain technology, mainly the Ethereum blockchain, you've got the possibility of not just sending to another person, but you can send to an algorithm. And that's where DeFi becomes alive. So DeFi is fundamentally peers trading with each other, and it's made possible with an algorithm. So I want to buy something, I send the funds to the algorithm, like a vault that's set up in the algorithm, and then the algorithm sends back what I want to buy.
And if you're a bank, you see that technology and you've got to say, okay, what's our future? Correct?
That is correct. So every major bank understands that their days are numbered.
They're going to fight tooth and nail.
They will. That, and of course they will. And so what they'll do is they basically embrace kind of the current wave of fintech, which offers some improvements. But that current wave of fintech is building upon the legacy infrastructure, whereas DeFi is a completely new infrastructure. So I think that the current wave of fintech is fleeting. Indeed, one of the speakers of my course colorfully described the current wave of fintech as putting lipstick on a pig. So like eventually, it's not really that hard to imagine that algorithms are going to be the main things that we interact with, not just in finance. So we'll have self-driving cars and things like that. It's not that hard. And if you think about the centralized system, the commercial banks, the brokers, they've been operating in the same sort of model for over 100 years.
And this is a magnificent irony to me, because they're really who people look as the, if you're I'm not going to get into whether capitalism's evil or not, but if you want to find the people who say, well, these are the capitalists, they're actually becoming a victim of competition to what they do. And they're the ones that are going to have to innovate or whatever. And I don't see how they do that. And so I think the irony is here we have this new competition against these banks where capitalism is actually could be their undoing.
Yeah, it's
ironic.
There's this concept of creative destruction.
Yes.
And so they're always turning over. But I guess my point is that there hasn't been that creative destruction for over 100 years in our financial system.
Yeah.
That it's basically the same commercial banks. Some of them have renamed, some of them have merged, the same brokers, the same insurance companies. So they really haven't been challenged. They've got market power, which means that I did a wire transfer the other day to Europe in euros. And my legacy bank said, oh, you're such a good customer. We're going to waive the wire transfer fee. And they expected me to say, thank you. But then they quoted the rate, and the rate was 2.5% off the market rate. And I said, this is the best rate you can give me as a good customer? No, 2.5%. So it's like swiping your credit card. That's completely unsatisfactory. Most people don't even realize that the rate is so far off. So they try to slow this down. I'll tell you an interesting story. I was invited before the COVID crisis to talk to some people at one of the leading stock exchange groups in the world on crypto. It was no set agenda. It was just vague. So I arrive. They've got the entire board of directors. They've got all of the senior management in the room. There's me, and there's a single question. How long do we have? So it's really clear that they know that eventually they will be disrupted by kind of algorithms that will make things much more efficient. You take out the middle person. That's the key. So you're dealing with your peer. That's DeFi. So you deal with your peer. As you say, people will do borrowing and lending in a different way where it's pooled together. There's no spread. Savings rates go up. The borrowing rates go down. And why are the savings rates so low and the borrowing rates so high? Well, it's clear. You've got the brick and mortar. You've got the bureaucracy, the back office.
Your blockbuster video. You are blockbuster video. Obsolescence risk, right?
Definitely.
I can't read Warren Buffett's mind. No one can. He's been criticized recently because they said, wow, he dumps his Goldman, he dumps his JP Morgan, he dumps a bunch of stocks, right? He was Berkshire Hathaway used to be a company. Now it's Apple, but it used to be it was almost like buying an ETF for banks when you bought Berkshire Hathaway in a way. I shouldn't put it that far. There's Fruit of the Loom and Dairy Queen. But he was criticized because these stocks gone up. Now I'm thinking, I don't know I just wonder if this is why, I don't know. It's interesting that Buffett would sell a guy who is a big fan of bank stocks. In the subprime meltdown, he bailed out Bank of America and made a great move on some warrants there. So it is an interesting thing. Now, the banks will fight tooth and nail. And I thought it was a very dramatic moment in the interview today when you said the only question was how long. Okay, the banks are one thing, they're commercial banks. Now, Federal Reserve Bank, quasi-government, private, we have a dollar. Some people say crypto's awesome because if the world goes to hell, you have these apocalyptic thinkers. Well, if the world goes to hell, I'll get on a plane. I can't take my gold on a plane, but I can take my crypto. Well, I don't like apocalyptic thinking, but I do think revolutionary thinking is something to think about. The Fed, does the Fed want to give up their control of the dollar, or do they embrace this, or how does the Fed react to this?
So the Fed, it's kind of interesting because the Fed realizes that if you reduce transactions costs, that's a good thing for the economy. So that's part of their charge.
Yeah.
But the Fed must also realize that this technology could disrupt them. And they actually don't need to look that far. So think about Venezuela as an example. So this is a country that's in hyperinflation.
Yep.
And for those that are kind of well off in Venezuela, they actually don't care if the inflation rate is 700% because they got a bank account in Miami. And that bank account is in dollars or euros or whatever, and they're protected. So it's really the average person that doesn't have access to an offshore bank that gets really taken advantage of that.
Yeah.
But this technology is changing that, because even if you've got a moderate amount of savings, let's say $200, you can have a bank in your pocket, your smartphone. That's your bank. And you can have not Bitcoin, not Ethereum, which are very volatile, but you can have a token that's linked to the US dollar or euro or gold. It's totally up to you. So the average person now can basically disintermediate the central bank of Venezuela. And you kind of see where I'm going here.
Yeah.
That why do we need the central bank when we've got the ability to pay with these tokens? So the Fed knows what's happening. The Fed knows that it needs to do something to improve. All of the major central banks have these so-called central bank digital currency initiatives. And we need to distinguish that from kind of a blockchain-based currency. In this situation, the Fed still got its control. There is a ledger that's shared, but the Fed can edit that ledger. So that means they can basically tax you. And if you think about policymakers, this technology is a dream for them because, especially with sales taxes and value-added taxes, people just get around it by paying in paper cash, right? So you can get around it, and it's, even though it's cheating, even though it's illegal,
but
people just do it. Exactly. Everybody does it.
I'll give you a discount if you pay me in cash. It happens all the time.
Exactly. So with a central bank digital currency, there would be no cash, but it also means that the government sees every single transaction. And in my opinion is that we will see these central bank digital currencies, but it's already the case that the central bank and governments have lost control of their money supply. So the crypto is a global phenomena. You might ban it in a country, but it's really hard to ban 10,000 different tokens. And it's just like too late. The horse has left the barn.
Yeah. Let's talk about education for a moment. You've taught classes at Duke on this. It's interesting how quickly people need to know, there's a crypto thing. How do I learn about that? So I go to college and learn about it. Here's what I find fascinating is the paradigm for, I think, most people is, well, I went to high school, went to college, got my degree, get a job, and that's what it is. But financial education isn't like that anymore. Financial education it's the exponential nature of how our markets are changing. I believe, requires or strongly suggests education is now just a constant in what you do. You don't necessarily, commencement means you move forward now with it. Well, I don't think there's the stop. We're speaking with Campbell Harvey, Dr. Campbell Harvey. His book is DeFi and the Future of Finance. And so I don't care if you graduated, 30 years ago, what you learned about money 30 years ago is completely obsolete. We had the 50-year anniversary of where Nixon takes us off gold standard. Bretton Woods changed. It's changing all the time. So I cannot strongly enough recommend. And I'll tell you that if I can just put on my salesman hat and sell the book for a moment, I'm never going to get a chance to go to Duke University and enroll in this class. If I turned in an application to those guys, they'd laugh me out of the building. They say, look, we couldn't make our basketball team and you can't make our business school team. So if you don't have the grades to get in, but you want to get information, I often sell books this way. I go, if you could take Dr. Harvey out to dinner and buy him a steak and bend his ear for an hour, you'd do it. And you'd pick up the tab for both the steak and the wine. Well, you get a chance to do much more than that here. You get a chance for less than that steak dinner to delve into a fabulous book. I just can't wait to get the feedback from people on this. There's books I have on my shelf and books I have in storage. This is one that goes on the shelf. I can't thank you enough for the time. Any counsel to the people who listen, and our audience are people who are investors, entrepreneurs, and people who really want to try to get out of working a job or at least protect themselves when this stuff happens. You mentioned could you provide us with that link? Maybe give me an email to that paper on best strategies for inflation. I think that'd be a start. And then also the book. But any words for those guys? You've been so gracious with your time. What are your final thoughts on education and what people can do?
I think of education, there's two dimensions. One are the principles, and they don't really change. So they don't depreciate. But there's another portion that's linked to technology that is constantly changing. And we've seen an acceleration of that technological change in finance. And it is important to invest in lifelong learning. And my book is part of that, where I teach my students at Duke, and that's not a lot of students. And I decided that part of my mission would be to hit a broader audience. And that's why I actually did this book. And what you don't know about is not released yet, but I've also put together 4 courses that will be offered on Coursera. One is called DeFi Infrastructure. The second is called DeFi Primitives. The third is called DeFi Deep Dive, which deals with the particular protocols and allows an understanding of the leading protocols. And then the last course is called DeFi Risks and Opportunities. So there would be plenty of opportunity for people to participate in a course or 2 or even 4 in this space. It is essential to continue to invest in your human capital. We are at a point that is an inflection point where usually we see these incremental improvements in our financial system. And we've seen that with the fintech, that it's more convenient to transfer a small amount of money and stuff like that. But this is different. This is like a structural issue.
The whole system's burned and created destruction. I mean, the whole
so this is where you build from the bottom up.
Yeah.
So it is important for all of your listeners to have a vision of the future. And that's important for basic risk management. I tell my students, many of which will go and take a job at a leading investment bank or a commercial bank or something like that. I said, okay, that's good. Get your experience there, but continue to invest in this space. And the very first day you get to that job in New York or wherever, you need to be thinking about where you're going to jump next. So you need to go through that exercise. You need to have another plan, a backup, or maybe even two backups, and you need to start working on it immediately. And again, a good place to start is something like my book. It's not the last stop, but in reading my book, I think what people will realize is, and I know it's going to sound a little backwards, but they'll understand what they don't know. And my last lecture, I said to my students, if you think that you understand all of the concepts that I've taught in this course, then I have failed. Okay, because that's really naive. So you need to know what you don't know. That's the first step in developing a plan. And it's a first step in risk management also. So I tell my students that I want them to be disruptors, not disruptees.
Well said. Well said. We've been speaking with Dr. Campbell Harvey, Duke University, just a tremendous voice and a very trusted voice. I wish if I read his CV, we'd have taken the whole time reading it. It is tremendous. The impact he's had. There's guys that talk economics and very few macroeconomics. As soon as you say, what should I invest in? They run for the hills. Well, I don't want to do that. Like, why are we studying this if we can't use the knowledge? And so he's one of those guys that actually, there's surveys. He's very involved. So you can tell I was a little giddy to this is a big interview for me to land. So I just thank you so much. And, go out and dive on the floor, get the basketball and get his book as well. And I just thank you from the bottom of my heart. I mean, it's just been a wonderful conversation. You've been so gracious with your time. And I hope you find it valuable. We have a lot of listeners. So I hope perhaps I could ask again if there's a big change in things, or when you come out with your courses and they're available, we could talk again. That would be great.
That'd be great. And I really appreciate the questions and you having me on the show, Andy.
This has been the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we try to make it simple. Our guest has been Campbell Harvey from Duke University. His book is DeFi and the Future of Finance, available on Amazon. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.